So I decided to do a second video because the first one for Tesla I got kind of cut off in a little bit, in a sense, so I could focus a little bit more on the short because I was like speeding it up. So we left off with the investor shorting Tesla, and I kind of gave an example of like what a short is. So, or I was starting to give an example, sorry, of what a short is. So essentially, a short is just like when you think something is going to go down. And I know you guys are probably, well, I hope you, if you guys haven't seen The Big Short yet, you guys should. Shout out to that. Was a really, really great movie. But so you have 100, so let's say this person here has 100 shares of Coke, right? Let's say, this guy's name is, I don't know, Tom, and we'll do Tom and Bob. All right, like super simple, right? Maybe I could use like a pen and like a water bottle. So basically, this dude, the water bottle has 100 shares of Coke. Like he's big chilling here, like he bought them a while back, and he says, like whatever, I got my 100 shares of Coke, and I'm earning like $1 a year on them, 25 cents every 3 months, right, in dividends, whatever, all hypothetical, right? And then Mr. Penn comes along and he's like, you know what? I think Coke, or in this case, like Tesla, whatever company, is way too expensive at $100 a share. That's ridiculous. So he tells the water bottle, hey, give me your 100 shares of Coke right now. Here's, and I'll give you a premium. So I'll give you like $10 right now, cold hard cash. Hypothetical. It could be 5, it could be 2. Obviously, it has to be something for him to lend him those 100 shares. So the water bottle's like, all right, yeah, that's cool. I got to keep my dividend, right? And the water bottle plans on holding Coke, for life or for a very long time, right? So the water bottle's like, okay, I'll give you my 100 shares of Coca-Cola, and but I want them back at this date and at this time. So let's say today's date is February 4th, 2020. So he's like, yeah, I want them back by June 1st, 2020. And in the meantime, he's still going to get his dividend, which would have been like, remember we said 25 cents every 3 months. So by June, let's just say he's still going to get his 50 cents in dividends, regardless of what happens to the share price. And on that date, on June 1st, 2020, the pen has to give the water bottle 100 shares of Coke back. All theoretical about, like, it could be a million shares, it could be one share, but like that's what it is. He's borrowing a company's shares from one person. So Coke goes out of the picture. The pen now has 100 shares of Coke. What the pen is going to do, pen could be a person, it could be Tom, it could be me, it could be you. We borrowed it from our friend, it could be, whatever. But we have the 100 shares. We're going to sell it immediately, to the market. The market is anyone and everyone. So boom, we get rid of it. So now we paid the water bottle $1 or $2, to let us borrow his 100 shares for, 4 months or whatever time that we worked out. And I gave him a premium. I didn't just borrow him for free. I gave him $1 or $2, right? Whatever it was that we agreed upon. And so we believe, like, hell yeah, we believe that Coke is too expensive. So let's say May 20th, we don't want to cut it too short. Let's say May 20th comes around and the sales report comes out and Coke's not doing good. And all of a sudden, like, the economy's slipping or whatever it is you think is going to happen in that time. Like, it's just too expensive or things don't make sense or that's whatever it is. There's a reason why you borrowed the shares, sold them. Now let's say the shares went down to like $50 a share. Like, it got cut in half, right? Like, just boom, like whatever that you thought was going to happen came to fruition. It came to realization. It came to truth. So now you're all happy, smiling. Why? Because now you go back to the market. This is just like the market. It could be everybody, whatever. And you're going to swoop up those same shares that you borrowed for 100. You're going to buy those for $50 a share. Bam, you made that flip. You just hold them now. You don't care if it goes to a million, it goes to a trillion, it goes to 0, it goes to 1. You've made your money, right? Because you borrowed it from the water bottle for, $100, and then you sold it to the market right immediately for $100. Now you bought it back for 50. You made a $50 profit. Well, whatever the premium was, if you gave them $2 or $5 or 10, whatever that is minus the 50, you made that as a profit. So on that day, when June 1st rolls around, you're going to say, here you go, water bottle, here's your 100 shares back. He has nothing to do with how much you sold it for, what you bought it for. He's a little bit sad, right? Because you know, at one time they were worth $100, those shares, but he sold them to, or he gave them to you to borrow for that time, and you turned around, sold it to the market, you bought it back for 50. You made money off of him. But he was under the belief that this guy is an idiot, because not only did, like, imagine if it would have went the other way. So now imagine, like, he was under the belief that it's going to go up. There's always a winner or a loser in the market. There is no middle when it comes to the market. There's a long-term loser, short-term loser, and just a straight loser, like Enron, Blockbuster, Kodak. Well, Kodak's still up, but, like, you get what I'm saying? And then there's some ups and downs. You have, like, the 2009 crash, whatever. But there's always positioning in the market. He let the pen borrow his shares. Why? Because he was like, you're an idiot. This guy's an idiot. Why? Because he believes the Coke was going to go up. So imagine if it did go up. Not only did he get the upside for it to go up, not only is he still going to get the dividend, you know what I mean? But he also made a premium. So let's say he said the pen would have, like, the initial deal was like, oh, I'll give you $2 right now if you let me borrow your 100 shares at like a $2 a share. So he gave him $200. And he's like, wow, this guy's a chump. Not only did I make $2 for letting him borrow it for 4 months, but when he gives it back to me, he's going to, and then, because, like, you're still going to sell it right away. That's what a short is. You're going to sell those shares right away. And he's like, it doesn't matter to me. I'm going to get those shares back. If they're at 110, 120, if they're at 200, you are under the obligation. You have to buy those shares back, and you have to give it back to him. So that's the bet. So in this instance, that pen is that investor. He's saying, yeah, Tesla is way too expensive. I will buy your Tesla share right now for $900. Like, I'll buy it from you. If you own Tesla share, I'll give it to you for $900. I'll give you, hypothetically, like, I'll give you $50 right now as a premium. Let me hold your Tesla share for 6 months, a year, 3 months, 2 months, whatever it is that I think that it's going to take for Tesla to go back down. And then I take that and I sell it right away to the share. I sell it back to the market. So I make that $900 and I just hold that $900 in cash. And in that 6 months, 3 months, whatever, if Tesla goes down to like $500 or $400 or whatever it is, I go buy it back cheaper than what I sold it for, then I give it back to you. And there's a bunch of other stuff that goes into it. Like, you know, there's such thing as a short squeeze, when all of a sudden, like, you got to have, like, really, you got to be like a true, like a connoisseur. You got to be like, just like true, like, you know the fundamentals, you know, and sometimes you can still get wrong. You get short squeezed. And what happens in a short squeeze is, even though I said, like, you go back to whatever, like, whatever shares, we don't have to use Coke or Tesla, but if all of a sudden I lent them to you at $100 a share, and I see those shares, and I'm holding it, right? And then all of a sudden, like, I sold it for $100, but all of a sudden Coke goes up to 110, right? Or Tesla goes up to 1,000, and you're like, oh my God, you lost 100 because you sold it for 9, and now you got to buy it back at 1,000. Or you sold Coke for 100, now it's at 110. You're like, oh shit, dude, I lost money. Not only did I pay a premium, but this shit's going up, and you still got that time frame. But then you start getting scared. Oh fuck, what if Tesla goes to 1,200? What if Coke goes to 150? So you end up getting a squeeze where you're like, oh, I'll buy it. But then what happens is, all of a sudden, if a lot of people are shorting that stock and everyone's getting scared because it goes up a little bit, and you're like, oh my God, I gotta go get this right now because I'm gonna lose more, you get a short squeeze. Because now the people that own the stock, they're like, oh, now you want to buy. Oh, you were still Mr. Sell right away, right? Oh, there goes my glasses. But they're like, no, now you want to buy. Well, guess what, dog? Now it's 120 for my Coke share. Oh, guess what? Now it's 1,300 for my Tesla share. And you're like, oh my God, it's going to keep bleeding up because there's a lot of people that short that are scared to lose. So they're like, oh, fuck, okay, I'll grab it. And that also causes the price to go up. So when you're playing that short position, it's very dangerous. I mean, you have to be very, very sure of yourself when you short. I mean, like in The Big Short, you can watch the movie, they break it down. It has Christian Bale. Do I say more? No, I'm joking now. But I asked Christian Bale in it, and it's really good, and they really break it down for, like, just people for layman's terms, and they like really explain it well, what happened in the housing market and why that guy made, I forgot the guy's name, but he had glass eye and stuff. But he literally was a genius. He saw that people weren't going to be able to pay their mortgages back, and he shorted the housing market by buying these credit default swaps. I mean, they do a better job explaining it than I will. There's a lot of other videos on YouTube. I mean, if you guys comment and stuff to explain it, I'll try to do it in my own, like, weird way using water bottles or something, you know. But basically, that's what a short is. That's what a short squeeze is. there's a lot more other ways to play a short. Like you could do just options. But that'll be a whole nother video because I can only upload like 15 minutes at a time. But essentially right now with Tesla, a lot of the short positions are starting to come on, and it also works the other way. Sometimes when investors see a huge short position come in, they kind of get frantic or a little bit scared. They're like, "Ooh, I was gonna go out and buy me some Tesla shares." But all of a sudden, you got this billionaire, or you got this hedge fund, or you got this money manager, this pension fund manager, or whatever, like whoever it is, buying up this big blocks of stock, shorting it. What does he or she know that I don't? Oh, maybe I should just sit back and wait. You know what I mean? Like, oh, what's up? So then that also sometimes drives the price down because then you don't get people rapidly buying, right? The pendulum swing, pendulum. I can't say that word, but it swings both ways, right? It's not always just one way, a negative way. Because all of a sudden, people stop buying. They're like, you know what, I'm going to hold, and then the price does start dropping, and well, these guys can make a killing. So, or the shorters can make a killing. So it really goes either way. But I think this gentleman's position on buying the short for Tesla is he just thinks the fundamentals are wrong and he thinks the price is overvalued, which, I mean, some people look at Tesla and they might think, yeah, it is. Some people look at Tesla and they think that it's just getting started. Just right now I was reading YouTube and Google's because they reported earnings earlier this week. They acquired YouTube for 1.6 billion back in 06. And at the time, everyone, or like a billion six or a billion, but basically like a billion plus, and everyone's like, "Oh my God, these guys are crazy! $1 billion for this." And 14 years later, $15 billion is what it made in 2019. 15 times the amount of money that they spent for it. And at the time, it was looked at as crazy. It was looked at as overvalued. So that's the thing. It's just like the world we live in, man. Like a lot of times we see a story, we see things, and as humans, like we're flawed, but I think genuinely humans are good people. We all want to do the right thing. Even like we're born, sinners or whatever, but like we want to do good and we want to see the world in black and white. We really do. We want to be able to say, because we want to be good. We want to be able to say that's bad, that's good. But unfortunately, just like in real life and in the world and investing and in business and in real estate, whatever, it's not always black and white. It's not always good and bad. It's not. It's a lot. Like we live in a gray world. There's a lot of gray areas. There's a lot of facts. There's a lot of like things that go in and play with each other that, the truth comes out. The truth of business stories, the truth of actual stories. So it's really, really hard. Like I would say my advice would be, and just because I lost money. I personally admit it. I made a lot of money back when I was trading, and I learned from it. I have my Robinhood account to prove it if you guys want me to send a snap of it. I mean, like, I was an idiot. I used to play earnings. Like, I was playing with, like, 100K. I was just stupid. I'm really embarrassed about it, and just, like, these are the things I've learned, and I want to pass it on because I don't want to see somebody hurt. I don't want to end up on Wall Street Bets like that idiot that blew up his account. I want to stop you guys from blowing up your account, and but yeah, I played earnings on Facebook once and I killed it. I think I made like 14K. And then I turned out and lost 16K on Goodyear because I just blew. I was like, screw the fundamentals. I wanted fast. And it just, I mean, you live and you learn, right? So I hate talking about it. Not that like I'm embarrassed about it because I'm a pretty open person, but it's just kind of like, God, I was such a freaking idiot. So it's like you really got to do your homework on this, man, because at the end of the day, like we do work hard for our money and everything that we do, whether it's using your mind, using your hands, everything, you're giving up your time that you could have been doing something else to earn that money, and you got to treat it as such, right? So it's just be careful when you're investing and try to know as much as you can. And some of it, like in life, it is faith. You got to believe, and if you think the numbers are there and you believe in it, you go for it. Do I think Tesla's a little bit too high? I just think there's better opportunities out there. I would just sit back and just kind of let the thing play out and just see where it goes. I mean, is there going to be an opportunity missed? Sure. You know what? Some of the best deals I've ever made in my life are the deals I didn't make. Some of the best deals I made are the ones I didn't make. My dad tells me all the time, he's like, in America, everything's always for sale. There'll always be an opportunity. You just got to take the ones that you want to take. Warren Buffett has a very famous quote. He's saying it's like, picking stocks and going out there and picking real estate. It's like if a batter and he's pitching you fastballs all day, you just got to wait for a slow ball. It means you don't always have to hit. Just because you have money, just because you can invest doesn't mean you have to. Take the opportunities that you want to take when you feel safe and you feel educated and you feel strongly about it. Thanks, guys.